where we're diving into our week ahead analysis. And let me tell you, we're looking at one of the absolute most critical macroeconomic stretches of summer 2026. The coming days are totally setting the stage for a massive week ahead in the global markets. We've got central banks holding their collective breath, major economies showing real signs of fatigue, and a data calendar that is just packed with market-moving catalysts. So if you're trying to figure out exactly how the global economy is kicking off the second half of 2026, well, you're definitely in the right place. Alright, let's take a quick look at our roadmap for the week. We're going to cover how growth is slowing while inflation lingers, China's high-stakes waiting game, the Fed's incredibly delicate balance, and our totally divided global economy. After that, we'll run through the week ahead watch list and wrap up with our Friday finale on US jobs. Okay, kicking things off with Section 1, growth slows, inflation lingers. Right now, global central banks are walking this incredibly perilous tightrope. On one side, you've got economic momentum clearly losing steam across the globe. But then on the flip side, inflation pressures stubbornly refuse to die down. I mean, they're just sticking around. Last week, central banks broadly opted to leave interest rates unchanged, but their messaging, crystal clear. Nobody, and I mean nobody, is ready to declare victory over inflation just yet. And honestly, this dynamic is the exact engine driving all the market anxiety we're about to unpack. Moving right along to Section 2, China's high-stakes waiting game. So China's Politburo recently met to hammer out their strategy for the rest of 2026. Now, earlier in the year, leadership was out there confidently describing economic performance as better than expected. While that language has entirely vanished, poof. It's basically the macroeconomic equivalent of ghosting. But rather than rolling out some massive, sweeping stimulus package to fix things, policymakers chose continuity. They pledged targeted support, things like accelerating local government special bonds and focusing heavily on AI development. This is a massive shift, guys. It strongly signals Beijing is actually willing to tolerate slower growth rather than resorting to the aggressive, broad-based stimulus of the past. And literally just hours after that Politburo meeting wrapped up, we got a pretty stark reality check. China's official manufacturing PMI unexpectedly slipped right into contraction territory, landing at 49.2. Remember, in this index, anything below 50 means contraction. Now, authorities were quick to point to severe weather and flooding as the culprits, but economists, they're looking a bit deeper. They're seeing really soft domestic demand, ongoing pricing pressures, and generally slowing business activity. Honestly, this 49.2 reading reinforces the exact same concerns that probably caused the Politburo to drop all that optimistic language in the first place. Now let's look stateside with Section 3, the Fed's delicate balance. The big question here is how the Federal Reserve is reacting to some seriously mixed signals. Under Chair Kevin Warsh, the Fed held rates steady between 3.50% and 3.75%. But here's the kicker. It wasn't unanimous. Actually, scratch that, it was highly contested. 3 policymakers dissented, actively pushing for an immediate 25 basis point hike, 0.25%, because they're really sweating the fact that inflation might stay elevated. Meanwhile, US GDP growth just slowed down to a 1.5% annualized rate in the second quarter, yet the Fed's preferred inflation gauge, core PCE, which strips out those bouncy food and energy prices, eased to a much friendlier 3.3%. So Chair Warsh is offering virtually zero forward guidance right now. Every single upcoming meeting is going to be 100% data dependent. Which brings us to Section 4, a divided global economy. You know that global monetary policy consensus we had a year ago? Yeah, it's completely fractured. Just look at the ECB at the top. Europe delivered a pretty positive surprise with GDP expanding by 0.4%, with Germany actually outperforming. Because inflation remains firm over there, the ECB might actually resume tightening in September. But across the Channel and the Bank of England held their rates, with Governor Andrew Bailey explicitly pushing back on the idea of any imminent hikes. Over in Japan, Governor Kazuo Ueda is on high alert for upside inflation as they slowly, carefully inch toward policy normalization. And way down in Australia, inflation slowed way more than expected, giving the RBA plenty of breathing room for patience. So yeah, we're looking at a totally fragmented global picture. Alright, let's pivot to the timeline in Section 5, the week ahead watch list. This timeline right here is the absolute core of our week ahead analysis. We're starting off with energy markets on Sunday, moving through some critical reads on China's private sector, then navigating US borrowing and services data by midweek. After a quick check-in on Mexico on Thursday, we're culminating in some massive US and Chinese economic updates on Friday. Let's break down exactly what you need to watch for on each of these crucial days. Sunday kicks off with energy. OPEC Plus is widely expected to approve a 188,000 barrel per day production increase starting in September. But honestly, the production increase itself is kinda not the main event. What oil traders are absolutely hyper-focused on is the guidance that comes with it. You see, OPEC has already slashed its 2026 demand growth forecasts 3 consecutive times. If their messaging acknowledges that global demand is weakening even further, oil prices could get incredibly volatile, and that ripple effect goes straight through the entire global inflation picture. Fast forward to Wednesday through what might literally be the week's most overlooked yet deeply important event, the US Treasury's quarterly refunding announcement. The Treasury basically has to reveal how it plans to finance government borrowing over the next few months. If they signal larger auction sizes to fund those expanding requirements, well, that could place some serious upward pressure on long-term Treasury yields. In plain English, that would severely tighten financial conditions completely independently of whatever Chair Walsh and the Fed are doing with interest rates. It's a huge deal. Also on Wednesday, we get the US ISM Services Report. Think of this as our real-time stagflation check, that toxic, nasty mix of stagnant growth and high inflation, specifically for the world's largest economy. Recent surveys have been hinting that economic momentum is slowing down, really weighed down by higher energy costs and shipping disruptions. We need to watch 3 key things closely here: employment trends, prices paid, and new orders. If we start seeing signs of persistent inflation paired with slowing business activity in this report, those stagflation alarms are going to start ringing loud and clear. And finally, Section 6, Friday finale, US jobs. Friday morning delivers an absolute massive 1-2 punch. First up, Chinese trade data. Now, so far, China's exports have been surprisingly resilient, mostly propped up by global AI demand and businesses rushing to front-load their shipments ahead of new tariffs. We're going to see if that export resilience can actually mask their weak domestic demand. Second, the US employment report. We're all looking to see if payroll growth can bounce back after a pretty disappointing read back in June. For that US jobs report, markets are absolutely laser-focused on the unemployment rate, waiting to see if it holds steady at 4.2%. But listen, the secret weapon here is wage growth. If hiring comes in strong and wage growth comes in hot, well, those 3 hawkish Fed officials who dissented last week and demanded a rate hike, they might just get the ultimate ammunition they need to push the whole committee toward a hike in September. So, as you watch the markets unfold this week, from China's PMI contraction to OPEC's demand fears, all the way to the US labor market, ask yourself this: will this cascade of data finally force Chair Walsh to abandon his patience and strike back against inflation this fall? The global economy is definitely slowing, but inflation just refuses to go quietly. Keep a really close eye on those Friday numbers. They just might give us our answer. Thanks so much for joining me for this week ahead analysis on The Explainer, and I'll see you next time as we continue to track these massive macroeconomic shifts.